Market chaos hit early this week as the fiat Japanese yen carry trade Unwind violently flushed various financial markets around the world. After having carried negative interest rates for over 8 years running, the Bank of Japan barely risen its interest rates into nominal positivity, where they currently stand at 25 basis points or plus 0.25% in positive nominal yields at the moment. Japan's artificially low interest rate environment for decades running has allowed leverage investors and hedge funds around the world to borrow the fiat yen locally, cheaply, and use those proceeds to speculate and lever up in financial markets around the world. Now, for a long time, this tactic has worked, helping many boost profits and bottom lines using the cheapening yen in carry trade loans. The trouble is, recent fiat Japanese yen strength blew back to start this week, and all sorts of market chaos and levered sell-offs ensued. Peter Boockfire had some sharp insights on this matter this past Sunday on CNBC. Have a listen.
Stocks are selling off globally, with Japanese stocks having their worst day since 1987. For more on what's going on there and how it's impacting us, let's check in with Peter Boockfire. He's the Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. Thank you for being here, Peter, as well.
Hi, Kelly.
Let's start with the Nikkei. We talked about this worst day since 1987, but the worst three-day move we've had since at least 1949. It's a 20% drop for the topics, at least.
The Japanese stock market benefited tremendously from the persistent weakness in the yen. Now, there are other positives that the Japanese economy has been going through, particularly corporate Japan, in terms of corporate governance, returns on equity, unwinding share cross-holdings, and so on. So there was a fundamental story to Japan. But I think what this is reflecting in is how much money people borrowed in yen to buy Japanese stocks among many other assets that are now unwinding.
And this goes back to their rate hike last Wednesday. Same day the Fed was holding rates steady here, the Bank of Japan decided to hike rates. It wasn't exactly their first rate hike, but it was one of just a couple since, March or so? Why did that so quickly kind of push things to the other side of the cart?
Well, it's sort of revealing itself. The Fed started raising rates in March 2022. It took the BOJ 2 years later just to get them out of negative interest rates.
Do you think they should have gone sooner?
They should have gone sooner when inflation was persistently above 2%. But by waiting, every month that went by, more borrowing was taking place in yen. It was the last place in the world to sort of get free money. And that free money, we couldn't necessarily quantify, but we're seeing sort of the result of the unwind now to say, wow, that was massive. We didn't really see it while it was going on to the extent that it's revealed itself to be, but it was obviously massive.
So here's the overnight rate, which we can see was negative for so long. Japan was trying to stoke inflation, and they had it. They had 2% of this, but they didn't move to raise rates until very, very recently. They got off of negative, as we saw in, maybe March. Then they finally hiked again up towards a 0.25 point last week. But it was this period that you think allowed all these carry trades to build up?
Exactly, because other central banks, the Fed I mentioned, the ECB, the BOE, the Bank of Canada, all the world central banks are raising rates except the Japanese. So if you're a carry trade person who borrows yen, well, you're borrowing cheap, you're getting a weaker yen, and you're speculating in all these different things, whether it's Bitcoin, gold, or tech stocks. So you were making money on both sides.
Yep, and here's the yen weakening to support that all the way really here through its peak just about a month ago. July 10th was when the Mag 7 peaked. We're down 20% since then. Similar move here. The yen has gone straight down to about 144 today. What do we watch for now?
So I think we need to see this sort of exhaust itself. The Japanese market has essentially crashed. 1987, when you have crash in 1987 in the same sentence, it tells you this is rather dramatic. The Taiwanese stock market at its worst day since 1967.
And Korea, too.
So I do think this is about to exhaust itself. Now, is that the all clear? I'm not so sure, because we also have other worries like economic growth and questioning the AI trade and whether tech can continue to lead the way. So this
of course,
is sort
it all has to happen at the same time.
Well, that's the thing. This all came together all at once. At the same time that sentiment was extremely bullish, you had excessive levels on the technicals in terms of the S&P relative to its 200-day moving average.
You said it was about 15% above the 200-day?
Usually about 13%. It gives me a red flag.
Wow.
Got to 15%. And then, of course, the global growth concerns and questioning the AI trade and all the investment and the monetization and so on and so on. Everything came together.
Reports on Monday were many of the retail public's largest stock market brokerage account websites were frozen and offline, leading many to deduce coordination amongst the brokerages. Whatever the reason, it's not confidence-inspiring, and that's to say the least. Let's put this week's yen carry trade unwind into further local gold and silver context using Japanese price charts. This tiny recent dip in the local fiat Japanese yen gold price reflects the market chaos from this week. Now, this chart goes back 20 years, and the overall trend is obviously higher up and to the right over time. On a yearly price chart showing the full fiat Japanese yen era, we can see the breakout and continuing price climb for gold in Japanese yen terms. Each blue bar is a positive year for gold. Of course, the inverse red bars are years in which the price of gold went down nominally. But the silver side of the Japanese yen is probably more insightful. As mentioned, spot silver sold off harder on Monday morning than gold did. But looking at the last 20 years of the fiat Japanese spot silver price in yen, it simply suggests a recent retest of the 4,000 yen per troy ounce breakout line. Perhaps you can see it now. It gets even more interesting on the full fiat era Japanese yen price chart. Here is that same cup and handle breakout that I just highlighted on the chart prior. And again, that's the recent retest line of 4,000 yen per ounce of silver locally in Japan. But this is only just beginning if we take into context that gold leads silver in bullion bull markets. Silver in fiat Japanese yen still has to triple before simply reaching its old 1980 nominal price high in fiat Japanese yen. Now I'm going to say that again so it sinks in. The fiat Japanese yen silver price still has to triple before simply nominally reaching its old 1980 price high in fiat Japanese yen. In other words, we are still so very early in this burgeoning global bullion bull market, and this chart screams that. It was no surprise that on Monday, calls for massive Fiat Federal Reserve emergency rate cuts went on air. Jeremy Siegel was Captain Crybaby for the day. Have a listen.
Joining us now is Jeremy Siegel, Professor Emeritus of Finance at University of Pennsylvania's Wharton School of Business, Chief Economist at Wisdom Tree. Jeremy, I hate, you probably aren't happy to say I told you so either, given what we're witnessing. But you thought the Fed was staying at, once again, for the second time, staying at the party too long and too restrictive.
Absolutely. And, this may surprise people. I'm calling for a 75 basis point emergency cut in the Fed funds rate with another 75 basis point cut indicated for next month at the September meeting. And that's minimum. The Fed funds rate right now should be somewhere between, 3.5% and 4%. Let me give you very simple logic of my position here. At the June meeting, the Fed has said that the long run Fed funds rate, when inflation reached 2% and unemployment has come up to 4.2%, should be 2.8. That's the normal. 2.8 is the normal Fed funds rate. Well, on Friday, we blew across the employment number. We're at 4.3. That even argues for a lower one. Now, as far as inflation, we're at 2.5%. We've gone down 90% towards the target on the inflation rate. We've overshot the target on the employment. Those are the two targets explicitly mentioned by the Federal Reserve. All right, and how much have we moved the Fed funds rate? 0. That makes absolutely no sense whatsoever.
He does have a point about unemployment zooming up of late in the United States. Now, this is generally a reliable precursor to an oncoming recession. Now, if the Bank of Japan's current balance sheet, 127% of their national annual GDP, if it's indeed a foreshadowing for where the Fiat Federal Reserve's balance sheet is going to have to ultimately trend to in our futures, multiples higher in order to keep this increasingly fragile fiat financial system from collapse, surely as the sun will rise again tomorrow out of the east, our fiat financial authorities, they'll be ready with their fiat currency creating keyboards when the next inevitable crisis comes about. Hello, this is James Anderson on behalf of SD Bullion. Smash the like button if you enjoy these bullion market updates, and be sure to visit sdbullion.com/sweepstakes to enter our free 500-ounce silver coin giveaway.
Make some room in your safe because a whole lot of silver could be coming your way. SD Bullion's Monster Box Sweepstakes is back, featuring 500 of SD Bullion's very own Silver Tree of Life coins in a Monster Box for the first time ever. This stunning silver coin is a highly detailed masterpiece featuring a hidden inscription on one of the tree branches that changes every year. So put on your best flannel and become one with the forest, and take your shot to win 500 silver trees from SD Bullion, because someone's gonna win it, so why not you? Click the link below for your chance to win.
The spot silver and gold markets closed lower on the week, mainly driven from Monday's yen carry trade unwind sell-offs. The spot silver price finished the week near $27.50 an ounce bid, while the spot gold price nearly erased all the losses from early on in the week, finishing at $2,430 an ounce bid. The spot gold silver ratio finished up on gold's relative strength, ending at 88. Do you remember that wacky $1 trillion platinum coin government fantasy that many MMT pumpers were promoting over the last few years? Well, it turns out the Obama administration and lawyers at the highest levels of government were actually looking into it in 2013, as a FOIA document recently released has revealed. Luckily, most of the details are redacted, blacked out, so the embarrassment with how our fiat financial authorities are behaving is at least somewhat still away from general knowledge. The damning debt and unfunded liability arithmetic in the United States remains increasingly on gold's side to come. Those are the most important points when it comes to the gold market in general.
David McAlvany joins us now, CEO and Portfolio Manager at McAlvany Financial Companies. Thanks very much for coming on the show. Give us the number one reason why you think investors should own gold right now, David.
I think if I was picking one reason that has some durability to it, it would be that we have a fiscal position here in the U.S. and in many other parts of the world, which is simply unsustainable. We've accumulated too much debt. Deficits continue to rise unnecessarily. We're not at war. We're not in a major economic crisis. And yet, in the U.S., as an example, $1.9 trillion in new deficits this year. That is not responsible from a political standpoint, and it's not sustainable from an economic standpoint. So we're getting to the point where we have terminal math that is going to translate into currency pressures and bond market pressures at some point. And I think that people should be looking at gold as a ballast asset within a portfolio, something to bring real stability for what we have ahead. So I think the other thing that people are looking at, particularly in the gold market, and this has been constructive all year long, I'd say the last 12 months, is a growing number of people who are looking at instability within the financial markets, and they want a safe haven. And this is, I think illustrated well this week with the blow up in the yen carry trade. You had two things happen last week. You had Jerome Powell basically say, here we come with lower rates in September. And that combined with the Bank of Japan raising interest rates, you've got a run for the yen and a short covering rally that is really indicative of this massive multi-trillion-dollar trade in the classic carry trade. Evidence all over the place if you're looking at emerging market currencies of the carnage which was accruing, and it was an absolute requirement that the Bank of Japan basically recant a part of what they were trying to do last week.
You think that the U.S. cutting interest rates, when and if it comes, I mean, the market, last time I looked, thinks it'll be next month. You think that could worsen instability in financial markets?
Absolutely, because the unintended consequence is it puts downside pressure on the dollar, at least as it relates to the yen carry trade. So downside pressure in the U.S. dollar and an improvement in the yen's position. So it just depends on how close you are to the edge with yen carry traders. And in this case, what we found last week is that we were very close. Perhaps things have stabilized now. It remains to be seen if we've sort of done with the worst, or if there's a lot more to come. I mean, we are talking about trillions upon trillions. This is one of the largest leveraged bets that's been put on, and it's been put on not over a 6-month period, but over actually several decades.
We're still rather early in the bullion bull, and private investment managers, their lack of gold allocations corroborate that statement. Once gold really begins outperforming the 60-40 portfolios in the years to come, discretionary investment managers and family offices are going to have to increasingly begin to build larger allocations into the precious metals complex. It's probably going to take gold going past 3,000 an ounce before bullion mania phase begins to get going. And there's still way too many complacent investors in the Western world, at least for now. India and other emerging market central banks, mainly in the Eastern world, continue adding to their sovereign gold reserves this past month and thus far in 2024. This will be the third year in a row of historically high central bank gold bullion reserve buying. It's forecasted to be again over 1,000 metric tons on net for this year, and it was over 1,000 tons in 2022 and 2023. A quick peek at the Chinese Shanghai Gold Exchange this week, and we can see recent daily delivery volumes of gold spiking to nearly 20 tons in just one day. The world mines and refines about 10 metric tons of new line gold per day, and apparently China needs well more than that physically of late. Rico Not Suave JP Morgan desk is calling for silver to break out in 2025. Various underpinning factors building for silver bulls. 36 an ounce very well could occur within later second half of this year in 2024. But whether we have to wait until next year, 2025, to begin really seeing silver break further to the upside, and that remains to be seen. I don't have a crystal ball, and I'm not going to stick my neck out to say when exactly that occurs. But we literally now have headlines stating that silver's industrial and ongoing military usage demands could deplete remaining just-in-time silver inventories, which would drive coming price volatility, i.e. Likely violent to the upside, and supply chain constraints regarding silver. The fact that the bullion industry premiums at the moment are currently razor thin, at least for most silver bullion and gold bullion products, while the silver spot is well below 30 an ounce, basically a gift for those looking to get prudently invested in position before spot silver makes its eventual upwards move back toward its seemingly ancient nominal price highs from 1980. Be it here in the West, in the USA, for instance, or out in the East, in Japan, silver is going to soar in relative value gains to come, universally speaking, and keep stacking while these spot prices are relatively low for now. That will be all for our weekly SD Bullion Market Update. And always to you out there, take great care of yourselves and those you love. If you enjoyed this video, hit the like button and share it with those you love. Subscribe to our channel and hit that alert button so you know when we publish new bullion market updates.